Hello income investors, welcome back to the Harvesting Income channel. Today we are discussing about HMAX. As you might have seen on the thumbnail, it's the Hamilton Canadian Financials Yield Maximizer ETF. Just a quick background, this fund was launched in January 2023 and the fund size is approximately 2.4 billion, and this fund holds the Canada's largest banks and financial companies. So the financial sector is a pretty large sector in the Canadian index, that is the Toronto Stock Exchange S&P 60 index. Financials have a major part in the index. So Canadian investors are more inclined to invest in these banks and financial companies. So let's unpack this ETF and find what are the major components, what are the different strategies they follow, and the pros and cons. So as we move ahead, quick disclaimer, this video and information is only for educational purpose, not financial advice. So consult with a financial professional if you want to make any decisions on investment. Okay, with that, the fund structure is basically direct holding of the stocks. This fund basically holds the Canadian banks and financial service companies. The investment strategy is pretty simple. They hold all these banks and financial companies and they write covered calls on these stocks. So that brings in income for the fund. It's a typical covered call fund, but it's focused on the financial sector. So it's a very sector specific fund. So it is not diversified, or it's not an all-in-one fund. It's a sector-specific fund. So it's the performance of the fund is tied to that specific sector. So that can be a pro or con, whichever way you look at it. But that is something I want to highlight, that you have that concentration risk. The fees for this fund is 0.65 and expense ratio is 0.71. This is similar to other max series funds in the Hamilton ETF series, max series. So under the maximizer series, they have these funds. So I would say it's reasonable. It's not too high, not too low. It's reasonable given the income nature of the fund and given the covered call strategies that need to be executed, and given the dynamic nature of the calls that the fund writes. I feel this is reasonable. Okay, now what is the returns that you are getting? The numbers here might be too high because in the past 1 year the performance of the indexes and the performance of financials have been pretty good. So price wise they have made 24% in the last 1 year. So this is the data for the last 12 months or last 1 year, and the distribution for this fund is about 11%. So overall in 1 year you made total returns of about 35%. So this is based on the data that is available as on June 30, 2026. A small warning here, like this is not a performance that may continue in the future. So in the future you may not see the same kind of yield, and for the next 2 or 3 years if you are going to look into the future, the performance may not be exactly the same. It could be slightly lower, higher, or same. I don't know, it can vary dramatically. So tread with caution, and the recent performance cannot be a benchmark for the future performance. I'm going to do a quick comparison which I have already set up here. I've compared this fund with another fund which is known as the ZEB, which is BMO Bank's equal weight ETF. So we have three different items here. One is the HMAX, which is in orange or amber color. Let me zoom in this a little bit so you can see the chart clearly. I hope that looks better. So here you can see on the left you have the HMAX, which is in orange. The last 1 year it has given 26.58% returns. This is total returns including the distributions plus the appreciation of the fund. Second, we have S&P 500 total return, just for the reference purpose. This has returned about 29.5% total returns over the last 1 year. Moving to the ZEB, which is the BMO Equal Weight Bank ETF. It has given us about 64%, 64.39%. So ZEB is the winner here. It is actually giving you more than double the amount of returns than S&P or even the HMAX. So you see this dramatic difference here. This is over the period of 1 year. What if we change the time period to, let's say, 3 years? Let's see what happens. I'm just clicking on this 3 year. Now quick comparison between all the three. You can see the charts. HMAX is at the bottom, 69.48% in 3 years. Again, it's not bad, but it is underperforming the index. S&P 500 at 72.52, a little above the HMAX. And if you look at ZEB, it's giving you 143.1%. It's on the top. So over a long period of time, ZEB is going to give you the highest amount of total returns. So if you're a growth investor or someone looking for higher total returns, ZEB is a good option. According to the data I am looking, at in Seeking Alpha. So let me look at a shorter time period. Let's say over the last 1 month, just for a example's sake. Over the last 1 month, if I look at it, again ZEB outperforms HMAX. ZEB is 4.8%. Sorry, HMAX is 4.8%. ZEB is 9.06, 9%. And S&P is kind of flat but slightly negative, like minus 0.69. Now, what if we move it to 6 months, just for an example's sake? Last 6 months. HMAX gave us 10.26%, S&P 9.33. This time, HMAX was able to beat the S&P. Now, ZEB is 27.48%. So yeah, you can see that impact happening here. Like in most of the cases, the covered call total returns is little different from the ZEB. But bear in mind that ZEB's portfolio composition is little different compared to HMAX. So that can also be a factor. So it's not an apple to apple comparison. But HMAX is doing its job, although it's not able to beat the ZEB. It's doing its job. I'll explain to you the other aspect of the portfolio, which is the holding mix, just to give you an idea. So this is about the returns, but let me show you the holdings of the fund. So if you look at the holdings on the left side, this is one of the kind of issues with this fund. Like if you look at the holdings, like it's all the major banks in the holdings in the HMAX. Royal Bank of Canada is about 25.2%, TD 17.8%, Bank of Montreal 10.7%, and then you have the Brookfield, CIBC. It's mostly all the big 6 or 7 banks plus other financial companies which are part of the HMAX. But if you see, the top 3 is highly concentrated in 3 banks. That itself is adding to more than 53% something. So that's something which is a concern that we have with this fund. So yeah, with that, let's go back to the slide. Now this is what we saw so far, 35% total returns. But there's a case where someone ended up having higher returns than what is shown here. Like I will present to you the findings because they purchased it one year ago, and so their yield on cost is little higher than what is mentioned here. But we'll look at the details later. But stay tuned till the end, because I'm going to show you a case study of holding HMAX. Someone held the HMAX by purchasing it 1 year ago. So that's the case study that we need to look at. Before that, we'll look at other aspects, like how the covered calls are written. There are two aspects to it. One is the covered portion and the uncovered portion. So HMAX writes approximately 50% of the portfolio. So it doesn't do the covered calls on the entire portfolio, but it does covered calls on half of the portfolio, 50% roughly. Sometimes it can be higher and lower. That would depend on the market conditions and the fund manager's call, depending on whether that stock or security will give higher appreciation or higher income. So depending on various conditions, they look at the volatility and so on. They would fix the strike prices and then the covered call writing levels. Uncovered portion can be about approximately 50%. Like assuming the coverage is 50, then the uncovered will be 50. If the coverage ratio is 40%, then the uncovered portion will increase to 60. So, so covered and uncovered are like complementary to each other. So if the uncovered portion is just 50%, the half of the portfolio has full upside. If the fund manager is covering only, let's say, 30% of the portfolio, for example, then the remaining uncovered 70% will have full upside, which means that uncovered portion has more opportunity for long-term appreciation or growth. However, lower coverage can also mean like slightly lower income. But if the market is too volatile, even a lower coverage can generate good amount of premium for the fund. So it's a little bit of a balancing act. Fund managers are professionals who can identify the volatile times and make use of that opportunity and write the covered call at a certain appropriate level to generate the appropriate kind of income. Now, on the calls which are written, there is no upside. There is no covered upside because all the calls are written at the money. At the money means they write calls at the current market level. So there's no appreciation there. However, on the uncovered part, there is a full appreciation. So that part is understood. So this gives you just a crux of the whole covered call writing strategy. So it's very simple and pretty straightforward. However, the fund doesn't do systematic or template or systematic writing every month on the same basis. They dynamically change the writing level based on the market conditions, which helps the fund manager to protect the value of the portfolio. So that's a good thing which I like about this fund. That's exactly what you need because as an investor, I cannot do the adjustment to the covered calls or the strike prices. Fund managers can do that, right? So so with that we are coming to the main part, which is about the pros and cons of this fund. One of the cons which we discussed is like it's a high concentration in the financial sector, but the financial sector is also a strong and stable area, so that's a positive point as well. The fund manager can write up to 50% of the portfolio for income generation. So the fund manager can reduce it a little bit or even higher. Mostly they keep it within 50%, not more than 50%. So usually the fund managers write less than that, or sometimes it can exceed, like depending on the situation. But usually it's up to 50%. And the uncovered part, like 50% or slightly higher, can have full upside. So that's the advantage of this fund. So even if the covered calls are written, to a lesser extent, you still have the opportunity for upside. And when you have that upside opportunity by holding stocks, it's not just the capital appreciation that you get. You also get good dividend yields from the banks because Canadian banks are known to give good dividend yields. Plus, they also have a good dividend growth track record. So that way, you are getting the opportunity for stock dividends from the banks or the financial companies. And the fourth point is like the fee is at 0.65, which is very reasonable for this kind of strategy and the dynamic way in which they write the covered calls. And the dividend stability and growth, which I already mentioned, has been factored into in the strategy. And this fund helps diversify across a basket of financial or bank stocks. So instead of buying RBC or TD or one particular institution and trying to assemble a portfolio or trying to pick different financial companies, you are able to buy the entire basket in one ETF, in one wrapper. So that makes your life easier. The last point is also critical. Unlike other Hamilton funds like the all-in-one funds, this fund has no leverage. So similar to the HMAX that we discussed before, this fund has no leverage. So that puts it at a safer zone for people who are not comfortable with leverage. What about the drawbacks? One is the higher concentration risk, and under that I would also highlight the second point. The other problem is it's not only the financial sector concentration, but the top three banks, RBC itself is like 25%. So if you put RBC, TD, and BMO together, it is going up to 53% of the portfolio. So that's a major risk. And the other thing is this fund can actually underperform the ZEB, like we discussed in the other example. I showed you the charts where the total returns of this fund is lower than the total return of ZEB. bank equal weight fund. And there is also a fund called HEB from the Hamilton, which is also a set of banks. It's a plain ETF with a set of banks, so that's also another option that you can look at. So those are the pros and cons of this fund that you need to bear in mind. Yes, there is a little bit of risk with this fund because it's not only a concentration risk but a risk of holding those top three banks. So if you're not comfortable with that, then you look at other funds available in the market. So ZDB is one of the options. So that's about the HMAX, which is the financial Canadian Financials covered call ETF. And we are coming to this case study now. So Harry invested about 100,000, and he's making 37.6% total returns in 1 year. So is this real or scam? Like, so what is happening here is original investment was 100K, $100,000, and this was purchased on June 30, 2025. So based on that price, the units accumulated were 6,859. So based on that, if you look at the average distribution per unit per month, like he's able to get 16.54 cents for every unit purchased. So he has purchased 6,859 units. So annual distribution income earned is 13,614.54. And also in the appreciation, like the fund appreciated in value in 1 year, right? So the appreciation was around 25%, I think. So 24%, like, so the appreciation was $24,005.49. You can see that here. So there are two ways you get the income. One is the appreciation, 24,000, and your annual distribution, which is 13,614. So adding up all these gains, like total gain is about 37,620, which is like 37.6% total returns. So dividend plus the capital appreciation. So now what is happening is, like, in the last 12 months, if you add up all the dollar amount of dividends that this Harry earned, it comes to about 1135 $1,135 for the last 12 months. But if you look at the current distribution, like the latest distribution they got in July, that was $1,152, because the dividend rate went up from I'll show you how much it went up in the distributions here. If you go to the distributions section, yeah, it is 1680. So it went up from 1670 to 1680 recently. But if you go back, look at June 2020, July 2025, it was 16.5 cents. Now it is 16.8 cents, I believe. I know it sounds like a very small amount, but if you are holding thousands of shares, this becomes a very big number. If you're holding 1,000 shares, you will be getting like $1,680. In this case, Harry is holding 6,859 units. So he's getting a whopping sum of 1,152 every month as of now, like, and this can keep growing, like. So in the past it was 1,135. It's gone up by roughly $17, and it's going to keep increasing like this. And not just the distributions are increasing, but also the capital invested has increased in value gradually, but still it has been increasing in value over time, maintaining the capital investment safe and also growing over a period of time. So that's the kind of return that you are getting from this fund. Harry made about 37.6% the last 1 year, which sounds like unbelievable, because never heard of this type of returns in a very even in covered call ETFs, which have not only the distribution yield, but also capital growth as well. So that's the power of this fund. And again, once again, a quick disclaimer here. This is actually not financial advice, and the distributions that you get from the fund can vary from month to month. So it's not going to be consistently constant, or it's not going to be growing all the time. Like we have seen, sometimes it has grown and sometimes it has stabilized or come down a little bit. But Hamilton has been good at growing the dividends over a period of time. But again, in the future performance is subject to market conditions. And so this was illustration or example of an investment made by Harry 1 year ago. So yeah, so that's the advantage of making long-term investments and holding it for a period of time after due diligence and study of the fund. I hope you like this video, and also hope you like this example. If you have any questions, any concerns, please drop them below. Thanks a lot for watching this video and for your time. Have a great day. Happy investing.